The stock market is ready for a downward adjustment. Nobody on the street wants to say that, but the reality is that stocks ran very well, both in 2023 and 2024. They had moments when we were worried about a recession. Remember last summer in August and September, everybody was wringing their hands. But generally speaking, stocks have really outperformed expectations. I would not be surprised to see them give back a little bit of that ground. But having said that, managers are fully invested, and they want to stay fully invested. You have ETFs that are more than half of the market today. What do they do when stocks go up? They buy more. So there is this long bias in the passive strategies that we see in the markets, and the only way you can fix that is to force stocks to go down. When they do, the ETFs are aggressive sellers. If you saw a real sell-off in stocks, it will accelerate, and we've already had people writing about this. So, we've had this long bias, and yet I can tell you that as I go and readjust our index at the end of January, I'm really thinking that some of these stocks need to trade off, because the performance isn't there. If you look at bank earnings, it's recovered, but it's nothing spectacular. I'm pretty optimistic about this year. I don't want people to think I'm pessimistic, but it requires leadership. If we get some real leadership in Washington, we can put aside some of the silly policies we saw under Joe Biden over the last 4 years, then I think we can make a lot of progress in this country. We have to remember that the federal deficit and the debt are demographic problems. They are a function of the baby boom. The baby boomers are dying. I'm at the end of the baby boomer, wave, but they had a big party and they left a mess, and now they're kind of exiting stage right. So the people who have an interest in the future have to focus on getting the U.S. government back under some control, because then the world is our oyster. We have nothing to worry about. There is no country in the world, including China, that can compete with the United States if we manage it in an appropriate and a sober sort of fashion. So that's really the challenge. And I think, Donald Trump is playing to the history books. If you look at the difference between the transition in 2016 and what we're seeing today, I think this group is very focused on making changes. I'm going to withhold my judgment until after the inauguration and we can find out really what he has planned. I think 2024 was not a bad year. We obviously were still talking about inflation, but we were looking for a recession, a consumer crunch, and it didn't really materialize. There's stress clearly among a lot of populations because of inflation, and they're cutting back spending. I thought it was interesting that the wine market is collapsing, both because of demographic and generational changes and other factors. But, what do people cut back first? They cut back on discretionary spending. And I think that's what inflation has done. The same group of people are having a really hard time buying homes, but again, because they just don't have the income. To me, 24 was really a transitional year because we still had so much cash from the Fed sloshing around in the economy that we couldn't get a recession to happen. We were talking about it, but by October, everybody had basically stopped that narrative. And Powell did another pivot, and, we ran into year end. It was okay, but interest rates have been rising, since the November election, over 100 basis points. The 30-year Treasury is back to where it was in 2022. And I think, unfortunately, we may see interest rates stay here or go higher in the new year. You always hear young people saying, I'd rather have an experience than an asset. They'd rather go on a holiday, go somewhere they would like to go. So I think the choices people are making are different. But at the same time, one of the measures I've written about in our letter is the reverse repos at the Fed, which is like them issuing T-bills. Once that disappears, you kind of know that the excess liquidity the Fed provided is gone. And I think for a lot of homes, a lot of households, you have enormous stress because they have to make choices. Do I make the car payment? Do I make the house rent payment? What do I do? And it's those sorts of choices that I think are slowly rippling through this economy. And it's part of the reason Donald Trump won. The cost of housing was probably the most important factor in the election, and nobody on the Democratic side wanted to talk about it. So as a result, they didn't do so well. That, to me, is going to continue to be the issue going forward. People are even joking about Trump potentially trying to resurrect his $2,000 stimulus payment that the House Republicans killed in Trump won. But it tells you that nothing's changed in a sense, because Americans are still under a lot of pressure compared to where they were 5 to 10 years ago because of inflation. Well, this year, I think you're going to see the numbers continue to bounce around because there's a lot of continuing inflation in the system. The question is anybody at the Fed or any of the other monetary authorities around the world willing to tighten enough to get rid of it? And the answer is no. They can't put the U.S. economy through enough pain, for example, to force home prices down. That would take 10, 12% interest rates, and I don't think politically that's doable. So the Fed is kind of going through the motions in a sense that they tightened for 2 years, but they didn't reduce reserves at all. In fact, they were adding reserves through this period. And I think it speaks to the fact that our public officials at the central bank are more concerned about liquidity and the stability of markets than they are about inflation. And I think that fact over time is going to become very obvious, and it's going to spill over into politics inevitably. Inflation in this country has been an issue for over 100 years. If you go back and look at the period between World War I and World War II, there was terrible inflation in the cities because of the lack of housing, really. It's a problem that comes and goes, but it's very much top of mind now for many Americans. Well, in 2008 and the first quarter of 2020, we had a really existential event hit the Treasury market. In 2008, we wiped out a third of all primary dealers. And in 2020, the Fed had to come in and buy the market. That's what they did in that first quarter, second quarter of 2020. They went in, they bought with both hands. They were scared. Obviously, a lot of people didn't know what to do during COVID, so they did too much. That's the typical reaction of Washington, right? And so now we're dealing with the aftermath of that. And I think to his credit, Powell has been trying to normalize the central bank. He's been trying to get it back to where it should be, as opposed to the way it looked, say, a year, 2 years ago after all of this extraordinary action. Powell is sitting on $2 trillion worth of mortgage-backed securities. They're going to be there long after he's gone because rates are higher than they were when those securities were issued, and homeowners aren't selling their houses. The level of prepayments today on those mortgage backs is 2-3% a year, which is extraordinary. In modeling, when we do models of prepayments on mortgage-backed securities, we used to assume a 6% minimum in the model, and now the actuals are half of that. So it just shows you how much has changed with the normalization of policy since COVID. And here we are with 7% mortgage rates. That may be where we stay for a while. I think if the Fed gets a statistic that suggests that the economy is slowing, then they may indeed give us another quarter point drop in the Fed funds rate. But I don't know that that's going to help long-term interest rates, particularly for things like mortgage and the bond market. Now, over the last 3 months, there's been a rally in bonds because spreads have tightened. Everybody and their mother who wanted to refinance something has jumped in and tried to take the opportunity. That's good. It will help to slow down defaults in corporates that are running at very high levels, by the way. I think bankruptcy and restructuring is going to be one of the themes for 2025, particularly in commercial real estate. We've talked about this. This is the gift that keeps on giving. It's going to be with us for years because it takes that long for these markets to clear. But for the consumer, I think it's a mix of a bag. Affluent consumers are doing fine. We've got 500,000 Americans in forbearance right now for their home mortgages, but that's nothing compared to where we were during COVID. It's hard to make the case that the economy is so weak that we need 2 rate cuts. And I think the posture you see coming from a number of observers is that they can't necessarily make a strong case for rate cuts today. Will they make the case in a month or two? Yeah. But I think there's a couple of no votes on the FOMC right now. And the politics of this are very interesting because, does Jerome Powell have a lot of incentive to be helpful to Donald Trump right now? I don't know. I think we're going to have to see after he takes office what happens. The Trump people have been very disciplined this time around. You'll notice there's no leaks. There's no commotion in public. They have locked down this transition process, and they're not going to have anything to say until January 20. Well, the big picture for Trump is, can he start to make progress on the federal deficit without digging a hole for himself politically? That's the bottom line. Americans don't like tax increases. This is something, that's historical going back centuries. And at the same time, though, the markets are not going to be kind to him either. If he comes forward with a proposal that greatly increases the deficit, I think the bond market is going to react very negatively to that. So that's kind of one thing that's definitely going to be on my radar screen. Another big prospective event is the release of Fannie Mae and Freddie Mac from conservatorship. If the Trump people go forward with this, the disturbance to the conventional loan market, which is half of the mortgage market that Fannie Mae and Freddie Mac underwrite, is going to be considerable. And I don't think that people have focused on this. I can tell you that the mortgage industry is still not focused on this. And there are a number of trade associations and lenders in Washington who are going to have to make a choice. They're going to have to decide, do I be nice to Donald Trump or do I oppose him on releasing these two very large finance companies from government control? So I think that's going to be a significant factor that I'm going to be watching this year. The rest of it is, the banks did very well in the fourth quarter of last year, especially after the election. Crypto, just about everything took off, right? You had banks up 45% at the end of December. That's not necessarily a normal thing for banks. The big performers like American Express and Axos and Ameriprise, they were up 60-70%. So that tells you that these markets are still very speculative, very much momentum driven. And the question is, do we see a more normal market in 2025? Once the interest rate picture gets a little clearer, once we really know if there's a recession in prospect, then I think a lot of other things are going to settle down. We published a piece on consumer credit this morning, and what I would say to your listeners is look at that chart that shows net losses for credit cards going back 40 years. And what you see is that the credit card market issued by banks has gone up almost threefold since 2008. The level of net loss, which we call net charge-offs, has basically been flat. So other than 2008, which was quite a horrific loss event, the numbers haven't been that bad. I have a lot of friends in the market who I love dearly who keep predicting the end of the world. And then I look at the data and it just doesn't show that. We looked at the top 6 consumer lenders. They're basically flat. Revenue's good. Funding costs have stabilized. Net losses are flat. They have not shown any degree of uptick that we've been waiting for. I mean, every analyst that I know has been waiting for this uptick, the hockey stick, right? In consumer delinquency, credit cards, autos, hasn't happened yet. So my suspicion is that consumers are cutting back on discretionary items and they're trying to remain current on credit because they don't want to lose their car. They don't want to lose their home. These are the things that they're going to defend, whereas they may stop spending money on going out to restaurants. And by the way, the guy running the restaurant is having trouble with inflation too. You could just imagine running a restaurant today when your inputs, your food, everything else has gone up by 50-75%. Well, let's look at it this way, and this really goes back to Trump 1. There is a conservative plurality in the House that wants to make big changes on federal spending. They want to see the deficit go down. So if Trump isn't willing to make policy changes that are supported by that group, then he's going to have to work with moderate Republicans and the Democrats to get things done. That means no change. I think that if we continue to see $2 trillion deficits every year, the U.S. is going to be downgraded. We're finally going to see Moody's downgrade them to probably AA+. And indeed, if Moody's has to look at Fannie Mae and Freddie Mac, I worked in the ratings business, as you know. The first thing they look at is the ratings that support the issuers that they're, looking at. And they may have to downgrade the U.S. before they downgrade Fannie Mae and Freddie Mac. Can you imagine that? Now, people have been anticipating this for a while. Moody's has had the U.S. on downgrade watch for a year. They've been on a negative outlook. So it wouldn't be a total surprise, but I do think that it's going to be quite shocking to the markets. And again, if Trump doesn't make real progress on the fiscal side, if they can't reduce that deficit, then the odds are that long-term interest rates are going to stay up. And he's going to have a battle with the Republicans. He just barely protected Speaker Johnson. Johnson was almost going to lose the vote. Trump came in and said, look, support him. Great. But if they don't placate that conservative group in the House and also the Senate, then I think they're going to have an internal war on their hands. Congress has been basically increasing everything 10% a year because they don't have a budget process on Capitol Hill anymore. It's a shambles. So I think that one of the things that Trump should probably consider is just simply freeze outlays on discretionary spending and freeze them for a couple of years because the economy grows. That's one of the things. If you use time and use the natural growth of the economy, you can get the deficit under control, but it means you have to say no to people. And this is not a population that's used to hearing the word no. So again, if people like you and I say, fine, we have to reduce the deficit, the question is where? Military spending, all of these areas that have been sacrosanct over the last decade, all of them have to be cut if you're going to make progress. And that's going to take a lot of work. Now, they have Elon Musk and other people who are supposedly focused on this. Washington is as it is. It's not going to change quickly. And I think that unfortunately, we're going to have to see some members of Congress who are willing to do the right thing, even if it means they get immolated in the next election. And that may be the case. Janet Yellen hid the budget deficit by issuing lots of T-bills. And she did this in part because it was also helpful to the Fed from a policy perspective. They wanted to buy short-term securities for their portfolio. Now, Scott Bessent, the gentleman that they've nominated for Treasury Secretary, has said the obvious, which is that we need to start issuing term debt. And that means that the long end of the curve, anything from 10 years on out, is going to go higher. Interest rates are going to go higher on mortgages, corporate bonds, everything else. The markets ultimately are the barometer politically in this country. So if the stock market weakens and goes down, that's bad for Donald Trump. If long-term interest rates go higher, again, bad for Donald Trump. How do you counteract those two things? You make progress on the deficit. Because if you make real progress on the deficit, if you cause long-term interest rates to stabilize and even fall, well, then you don't have to worry about the Fed, do you?